Wednesday, October 4th, 2023, Maneco 64, home of alternative economics and contrarian views. There are many out there who think we could be entering a 1930 style Great Depression. Anything's possible. But one thing I would say is that the ingredients for a crisis now are completely different than in the 1930s or the 1980s. And that's what we're going to talk about today. Of course, the bond market is at the center of everything, especially the treasury bond market, the government bond markets all around the world. And we're going to cover that as well. And I'm going to try to compare the 1930s to now. I'm going to look into gold, what gold really is. But before I do, just like to let you know that I still think it's really important, at least for me, to have something outside this financial banking system. And of course, that is in the form of gold and silver. That is in the form of money, of course. There's a lot of other things, not just financially, that we need to work on in these turbulent times. But I'm here to talk more about the financial monetary aspect of things. And I just wanted to let you know again that Oliver Temple at Gold Investments in London, he still got 5% off on the price of the various dates sovereigns. I think it's a good deal. I've added on to my stack. Silver as well will do well, in my opinion, outside the system. It's a good, good money to have. And for my viewers in the US, they can try to get in contact with Oliver, but I also have two affiliates, ITM Trading and Miles Franklin, and all the details are below in the description. So back to the 1930s, and I'm going to go through the 1930s and why we had the banking holiday when Roosevelt took office in March of 1933. Yeah, back then the president was inaugurated in March, not January. So, of course, we had the crash of 1929 and the economy went into a massive slowdown. The Great Depression, some argue, was triggered by the stock market crash, and it might have been so. But one thing that really made things difficult for a lot of people, and most people think people lost all their money in the stock market, but it was more because they lost all their money in the bank. And what triggered in my opinion, from what I've read and studied, the 1933 bank holiday in the US was the collapse of the European banks, especially Credit Anstalt. I think that was in 1931, and a big Austrian bank. And a lot of American banks, or some of the big, I would say, could have been New York banks, they had lent money to Credit Anstalt. And by 1933, the U.S. banking system was in trouble. And how did it work back then? Because I see a lot of people saying that if the whole system implodes, if we have a Great Depression, that gold is going to collapse because the dollar is going to be strong. But as Rafi Faber always says, technically the dollar, the currency, because it's a currency, not money, is still gold-backed. We can still get a little bit of gold from the dollar, as we've seen in that chart I've shown you, how many grams of gold you can get for $1. I think it's getting to like 0.016. It's getting smaller and smaller. Back in March of 1933, you could still get for $1 1/20th of an ounce, to be exact, 1/20.67 of an ounce for a dollar for a promise to pay a dollar. That was what you were paid in gold or silver. And I think a lot of people who say that, well, gold and commodities are going to collapse. So what I'm trying to say here is that in 1933, if you look at this coin here, this is a $10 gold coin. It says $10. That gold was money. And you've also got $20. So what happened in 1933 is that a lot of people had these, the national currency, issued by some of the banks, right? Or a lot of people had left their money in the bank. And what happened? Well, in the 1920s and in the early 30s, banks issued too many of these, and there wasn't enough of these to cover all the issues of currency, and that's why people went to the bank and they were withdrawing their money. Could have been in gold. It could have been that they had some of this in the bank too, but I would say it was mostly this. And by the time Roosevelt was inaugurated, the whole system was imploding. It was pretty much like it was earlier this year in March, but it was a lot worse. There's a lot more banks failing. And at the time, of course, the Federal Reserve didn't have the tools that it has now to kind of stop these bank failures. So what Roosevelt did is he declared a bank holiday for a week. And at the same time, he used a 1917, I think, executive order or act, an enemy act during World War I that was passed to incarcerate Germans that were resident in the U.S. And he used that against the American people to confiscate gold with Executive Order 6102, I think. And he basically said that you had to hand in your gold to your local Federal Reserve Bank. And a lot of people did. And what they get in return, they got Federal Reserve notes. That's what they got in return. And at the time, of course, 1 ounce of gold was the equivalent to $20.67 currency-wise. So this $20 gold piece was actually just under an ounce. So he confiscated the gold, or most of the gold. I'm sure a lot of people didn't hand it in, but he made it illegal to use gold as well. So that would stop the bank runs. And then by January 1934, what he did to reliquify the system was increase the value of the currency in terms of gold, or increase the value of gold in terms of U.S. currency by 70%. So he revalued all the gold holdings that now the Treasury had, and then eventually they put that gold in Fort Knox, which was built for that. They revalued it to $35. And so the people who handed in their gold, they got screwed by $70. And why did he do that? Well, because he was trying to inflate the system. He needed that profit for the federal government to start his New Deal. So all throughout the 1930s, one of the best performing stock was home-stake mining. So this is why I say, when people say, well, gold is going to collapse, like in the Great Depression. Well, gold didn't collapse. Gold was the most important monetary asset for the U.S. government. And people fell for that. Will they confiscate nowadays? No, because gold is not really monetized, and the market will do that. They will revalue the gold for the government. That's the way I see it. So that's why I don't think gold is going to collapse, even if we see a depression. But I don't think we can look back at 1933 or the Great Depression or even 1980 and say that we're going to experience the same. And to be honest, I don't know how it's going to be. And why do I say that? Well, because if you look at the government or the public debt in 1933 was $20 billion, and the GDP of the US at the time was 57 billion. So the debt was 35% of GDP. In 1980, funnily enough, it was the same, 35% of GDP. So Paul Volcker had a lot of room in terms of the debt. He could let rates go to 20%, let the 10-year yield drift up to almost 16%, because Uncle Sam, despite the double-dip recession of the early 80s, Uncle Sam was not really in trouble fiscally, so it could handle those high interest rates. But now, with deficits running like at 2 trillion into double digits annually as a percentage of GDP, almost into double digits, we're near 6 or 7%, which is more like a recession-like deficit, and 33 trillion in debt, which is over 120% of GDP. Of course, yes, the debt held by the public is around 100. It's very different. And when you see bond yields or treasury yields going up as they are, it's worrying. And that's why I say, can the Fed come in and save the day? That's the key question people are going to ask. Can they do QE? Well, the thing about the Fed intervening monetarily is that if it's going to have a big impact on the markets and if it's going to help yields go back down, it has to be done in conjunction with the fiscal policy. And right now, lo and behold, we have a problem in the House of Representatives where the U.S. government's power of the purse lies. So Kevin McCarthy ousted as House Speaker by Republican rebels. Revolt by hardliners unseats GOP leader, bringing fresh turmoil to Washington. Yeah, and they go over the fact that this is the first leader of the House, of the lower chamber, to be removed from his position. So it is significant. The other thing that they note is that the congressman from Florida, Matt Gaetz, he has a personal vendetta against Kevin McCarthy, and that's why he's voted with the Democrats to oust him. But I would say if you listen to Matt Gaetz, which I have in the past or in the last few weeks, what he's saying is that the debt is getting out of hand. He mentions the $33 trillion in debt, and he mentions that ever since the 90s, the way Congress or the House votes for spending is to put everything in one bill, so it doesn't allow Congress or the House to pass each spending program separately. And he says that's the whole problem, and that's what he wants to change. And earlier in January this year, McCarthy promised Gaetz that they would change that, and they haven't. So it's all got to do with all the debt and the spending. And I think what the Fed could do now is they might sit on their hands and let everything collapse. And they could blame this far right wing, as they call Matt Gaetz. He had a personal vendetta against Kevin McCarthy. but they won't talk to you about the fact that the debt is unsustainable. The interest on the debt is getting out of hand. And the Congressional Budget Office, they forecast even themselves that the debt held by the public is going to double in less than 10 years. So I think that's the whole problem. And as for the bond market, yeah, it's doing really what it should now, because I've said many times that nothing lasts forever. The 40 years of the bond bull market that we had from 1981 to 2021, I think that's over. And I've made videos about that. I did one back in December of 2020 about the secular bond bull market. And I actually looked at the cycles, and I said we could see the end of the bond market here. Of course, the bond bulls, I think they're getting, how can I say, trampled now. They're in trouble, because they thought the 40 years of always seeing, yields rise and then come back down and bond prices go up. They thought that was going to last forever, and I think they're being proven wrong right now. I also warned in December of 2022, I said long-term cycles point to at least 20 years of rising bond yields. There you go. And what else? I've got a warning back in August this year. Stormy bond clouds hovering over financial system. So, yeah, you want to be out as much as possible, I would say. That's my opinion of the financial system. And why is that? Well, it is similar to what happened in 1933. I did a video recently as well that there's no cash, really, virtually no cash in the bank. If you got $10,000 and you think you can go there and get it out, think again. I used Fed data, vaults, in cash in the vaults at all the major U.S. banks. On average, there's less than half a cent of a dollar in cash at banks. Is it any wonder they want to take you off cash and take you digital? So that's what's going on. I don't have a crystal ball to know exactly what's going to happen, but what I can tell you is that all the ingredients for this situation that we're in is there. All the ingredients are there. The heavy debt, heavy government spending, yes, the leverage as well in the financial system, the derivatives. I mean, it's all a mess. And we just need to wait and see if the Fed is going to react, or if they're going to sit on their hands and blame Congress or the House for all the troubles. And is it any wonder that foreign governments are continuing to buy gold, because they know this is coming? I think the Chinese and the Russians, they've known since 2008 or even earlier that it would end like this. So, yeah, there are those who think, the debt doesn't matter, we can just keep going. But I think this time is different, as they say. So, with that, let's quickly look at where the markets are this morning. It's 8:37 a.m. London time. So let's first look at the bond market today. The 10-year Treasury, got up to 488 overnight. So right now it's at 485. So amazing how quickly it's spiking after it broke through that 433 level. And I remember a comment last week. Oh, you said once we broke through 433, all hell was going to break loose. And I said, well, it doesn't happen right at the, instantaneously. It takes time. And I think I'm being proven right at the moment that it is starting to create havoc. But anyway, right now it's drifted back down a little bit. We're at 485. The 2-year is at 516, the 2-year yield. That has gone up a little bit as well, but not as much as the 10-year. So the spread there right now is around 31. And I think when I did my video last year about the yield spread, the 2s, 10s, it was around 48. So it's continued to steepen. And as I said as well, whenever you get from a negative or inverted yield curve and it goes back to flat, it's a sign of a huge crisis or a recession. So we're getting quickly, very quickly to that level of 0. And I think the 10-year is going to be the one that moves the most, i.e. upwards. So that's the bond market. Not out of the out of trouble yet. We might see a respite, a rally, but I would say that would be an opportunity to sell again. Anyway, we got spot gold at 1820. It's down a couple of bucks. Highs 25, low is 16. Silver is down 12 cents, trading at 21.02. Low has been 94, high 21.24. Well, the Dow futures, I think we lost over 400 points yesterday. Right now it's down 150. The NASDAQ is down 111, and the S&P is down 27. To the currencies, sterling is down slightly at 120.69. The euro is up slightly at 104.74. And the dollar is unchanged versus the yuan at 732. Let's not forget the dollar, yen. The dollar is down 0.1% at 148.81. I think yesterday dollar got up to just below 150. So that's the other thing we need to keep an eye on. If the dollar continues to strengthen, or so that's the other factor we need to keep an eye on because of the yen carry trade. If the dollar drops back or the yen strengthens, that's going to be even worse for the bond market. It's going to put higher pressure on yields to go higher. Aussie dollar is up 0.2 at 63.15. The dollar is unchanged versus the Canadian dollar, 137.06. Kiwi dollar is down 0.25%, 58.92. Let's look at the commodities. WTI crude is down 0.75% at 87.70. Brent is down 2/3, just above 90. Platinum is trading at $867. That's down about $4. And high-grade copper is coming off as well. It's down 0.75, trading at $360. So with that, I'm going to wish you all a very good day. Take care. Bye.